Hey, what's up everybody? It's your mortgage expert, Brian McCauley here. So you're looking to buy a house in Dallas, Texas, but these 7% interest rates have you concerned, and you've been hearing this buzzword around assumption loans, which is buying a house, but assuming the existing person's mortgage that might be at 2, 3, or 4%. Is it really as good as it sounds? Stick around. In this video, I'm gonna teach you everything you need to know. Let's get into it. So believe it or not, home prices are almost at an all-time high. Mortgage rates are hanging around 7%. So how is it possible that we haven't had a crash? Well, there's a couple things when it comes to specifics where people thought last year the market was gonna crash. It's softened a tad, it's already made the correction, it's on the upswing right now. And so people are having trouble with affordability. They wanna know, man, there's not enough inventory. What's out there is being bidded on by every buyer because there's way more buyers than there are houses, which is causing prices to go up. Number two, interest rates are hanging around high 6s, low 7s. And so the problem is that the potential home buyer and consumer can't get a break. So there's a couple ways to get a break, and one of the most popular buzzwords that's out there right now is an assumable mortgage. So it's not as easy as it seems, and in today's video I'm going to go through what an assumable mortgage is, what it can and can't be applied to, whether you're a seller, whether you're a buyer, how the mortgage companies view that, and then at the very end, stick around, I'm going to teach you a secret. If you want to assume a mortgage, there's a much faster and easier way to do it, but I want to be able to walk through that with you. So let's talk about assumable loans, okay? Assumable loans are mortgages that a current homeowner has on a house that either the government-sponsored entity or the investor or the servicer is deemed assumable. What that means is if somebody wants to buy that specific house, and instead of coming to me and getting a brand new loan to start their own fresh mortgage, pay off the existing note, pay everyone out, if the mortgage is assumable, they can buy the house from the seller, they can go to that seller's servicer or that seller's mortgage company and say, hey, I am Jane Doe, I am John Doe, I want to apply to assume the mortgage. So why would anyone do that? Well, we all know during the COVID run, a lot of people out there have interest rates in the 2s, the 3s, the 4s, and even the 5s. And right now, those numbers are much more appealing than a current 6.99 interest rate. People care a lot about affordability, but if they can, buy a house at the price that they and the seller can agree to, but instead of being a brand new home loan at 6.997%, they can take over the existing home loan at 4%. It makes it much cheaper on them, and they're more inclined to perform on the payments, but they're also much more inclined to buy the property. Because if the property comes at a super cheap rate, wouldn't you want to take that deal as well? But here's the downside that a lot of people don't know, and I see this too often when sometimes sellers or agents are listing a house. They will say, 1, 2, 3 house for sale, and the mortgage is assumable. So first things first, I want to get into, not all home loans and mortgages are assumable. The two that are always assumable is an FHA loan and a VA loan. So if the owner of the house currently has an FHA mortgage, or the owner of the house currently has a VA mortgage, and you are buying their house, you can potentially assume that mortgage because it's assumable. Now, you don't have to qualify via FHA, you don't have to qualify for VA like you would on a new home loan. Because those are already assumable, you just qualify to make sure you have what's called the ability to repay, to take over the payments. So here's where the weird part happens, that a lot of buyers and sellers and agents don't connect the dot all the way through, and it ends up being a challenge later. So VA loans, always assumable. FHA loans, always assumable. Conventional loans, from what I've been told in the research that I've seen, almost never assumable. I think there are a few exceptions. I think one of the exceptions is if it is a conventional loan that is not a fixed loan. If it's an adjustable rate mortgage on a conventional loan, I believe those can be assumed. Or it might be the other way, where you can't do ARMs and you can do fixed. But I believe you cannot do conventional loans that are fixed. You can only do conventional loans that are ARMs. Those are the only ones that are assumable. Don't hold me to that, but I'll go back and check. There are a couple other types of loans that people are familiar with out there. USDA loans, jumbo loans. Jumbo loans are just really big loans. They're really big conventional loans. These loans are not assumable. So it's really just FHA and it's really just VA and there's some type of conventional loan in there, I think it's an ARM, that technically are assumable. Just because it is assumable doesn't mean that they'll let you assume it. So let's get into that part. Hey, I make an offer on a house, they accept my offer. I say, hey, Mr. and Mrs. Smith, I want to assume your FHA mortgage. You have a 2.99 interest rate. That payment is super sexy. I'd much rather have it than the 6.99. Let's go do the assumable part. So what happens is the existing servicing company and the mortgage company has an assumable department. The owner and the buyer will submit a contract and a deed and all these things to the servicing department. And really the new buyers that want to take over that assumable loan have to submit all of their financials to the bank. It's the same thing as a pre-approval. Like if a servicing company and mortgage company is going to let a new person take over an existing loan, they want to know the same things that regular mortgage companies want to know. What's your credit score? What's your income? What are your assets? What's your overall debts? Do you have the ability to repay the loan? And are you at any high risk? Because they're not just going to take a great performing loan from an existing person and let somebody else assume it if they're going to default on it sometime in the near future. Because again, mortgage companies are in the business of making money. The way they make money is you have to make the payments every single month, so they have to qualify, almost pre-approve the person that is trying to get the assumable. Normally, I would say assumable loan qualification procedures take anywhere from probably 30 to 60 days, okay? Sometimes a little faster, sometimes a little longer. It all depends upon the mortgage company and the human beings, right? If they move fast like me and move fast like you, great. But some of them are slow and they don't actually care to transfer the loan and let you assume the loan because like they're already making payments on it, but they have to if someone applies and it's assumable. Sometimes they will approve it and say, okay, you are approved to assume this loan. Here's all the paperwork behind it. You're going to take Bob or Stacy's loan. You're going to assume it. Here are the terms, 2.99 interest rate. Here's the new balance. Everything is good. Here's the payment. And that person legally assumes it moving forward. They close on the transaction. There's a lot of stuff that goes on behind the scenes, but they get approved. Sometimes they don't get approved just because their credit scores, debt to income, and all that stuff. But here's really where the rubber meets the road that I want you guys to pay extra attention to. So if somebody buys a house, we're going to use round numbers. Let's say they buy a house for $300,000. The people that own the house right now have a 3.99% FHA mortgage. The payments are super cheap. And let's say those owners owe $250,000 on the mortgage. Well, here's the part about assumable loans that no one talks about that really throws a wrench in the game. If the buyers of that property get the contract accepted, they go to the assumable department and they get the assumable loan approved, now they're super happy because they've got a $250,000 mortgage with a 3.99% interest rate with dirt cheap payments, and they're all excited and they're ready to go. But there's a problem. The owners are selling the house for $300,000. The buyers are assuming the loan for $250,000. We have a $50,000 gap in equity that these sellers still need their money, and they're not going to walk away and close on that deal without the money. So where the buyer has the challenge is if you were to get a traditional loan from me, even though the interest rate is higher, we obviously would do a $300,000 loan, maybe minus 5% or whatever, and we cover up all that equity and pay everybody off and everyone's made whole and everyone's happy. And these scenarios where somebody has a sales price and they have a good amount of equity, 30, 40, 50, 60 grand, that buyer that assumes that loan has to pay that seller the delta and the equity that they have in the property because they need that money. There's a couple ways that this can happen. Number one, if the buyer just has the money in the bank and says, yeah, cool, I've got 50 grand, I'll pay you that 50 grand. That'll be the difference between the 250 balance and the $300,000 contract price, and we're all good. That's part one. Sometimes the buyers don't have the money, so then they're like, oh, I didn't think about all that. How am I going to pay these sellers? The second part is buyer can go get a secondary loan. They can go get a second mortgage. They can go get a personal loan from SoFi. They can go pull money from their 401k for 30, 40K and pay them that gap, the delta. The downside with that is the whole reason they got the assumable mortgage at 3% or 3.99 is because they love the payment. If they've got to go get another second loan, whether it be a mortgage, whether it be a personal loan, whether it be a 401k loan, all of a sudden now they have another loan payment. And so when you take that original really sexy good 3.99 rate in payment and you stack on another loan payment on top of it, it really defeats the purpose of having the super cheap interest rate and the super low payment, because now you have a combination of two loans and it really defeats the purpose. And if that's what you're going to do, then it's like you might as well just get a traditional loan, wipe it all out, and not have to worry about going and finding other, resources to pay the seller the money. The third thing that a lot of sellers will do is they will do seller financing on the equity. Let's say, again, for an example, they have a $50,000 equity position. They might not need it all. So they might say, hey, what I'll do is on the $50K that you owe me, I'll give you 24 months to pay it. You give me $10,000 now, and then you can finance the $40,000 in equity. You can make me payments every single month, installments for $2,000 a month for the next 12 to 24 months, whatever the terms are. And then at the very end of that term, they're paid in full. Now, the problem with that is now they've got a more mortgage payment, and now they have an installment payment on equity for the seller. And so that bottom line payment is not super sexy anymore because you're combining stuff. What a lot of sellers will do in this scenario is say, hey, why don't you just pay me $500 a month for the next 24 months, and then let's do a balloon payment at the end of 24 months and you pay me the rest. And so what the new homeowner will do that's buying the house and taking over the loan, they'll make the minimum payments, they'll figure a way to save up money. Maybe they look at a refi in the future, doing a HELOC or something, but just because that first lien and that rate is so attractive, they will find a way to bridge the gap where they don't have to get into another loan, deplete some of their own funds, tap into their 401k. But this is why they do like a 2 or a 3 year minimum payment with the balloon, because the seller eventually needs all the money. So the last piece is, well, why wouldn't the seller want all the money out of the equity? Well, that comes to the question of Mr. and Mrs. Seller, the $50,000 that you have in the house. What are you going to do with it? Do you actually need it? And you're gonna take it and go put it as a down payment on a new house, or you're just gonna stick it in the bank, or do you want it? If they need it, they're gonna ask for it in full. If they want it, say, hey, what I'll do is make a small upfront contribution of 10 grand towards the 50. Let me finance the 40 grand over 24 months. I'll make minimum payments. We'll do a balloon payment in 24 months and I'll pay you the rest. Sometimes sellers will do this if they don't need the money. They can make money on the interest, but also when it comes to capital gains, if there is a capital gains tax on that equity that they're going to be getting, if they don't take it all at one time, aka 50,000 bucks, they don't get taxed on the full 50. They would just get taxed on the small payments that is being given from the buyer each month. So therefore it helps them a little bit from the IRS code as well. And so all parties win. Now, same concept applies for a VA. The only thing is if somebody's a veteran out there and they let somebody take over their VA loan, even though the bank lets them assume it, if they try to go get another VA loan and they don't have enough eligibility, that veteran may not be able to get a new VA loan on a property in the future, which is something a lot of veterans like to do because it's 100% financing and it is a really competitive interest rate. Last but not least, if this video is helpful, but you don't think it's a fit for you, there is another alternative way to buy someone's house, take over the mortgage payments, not have to go to the servicer, and you can still have the deed. This is applicable for all loans, but it's a different strategy, contract, and structure. If you're interested in this strategy, drop a comment below. I'll have you go look at my old sub 2 video, but I'm gonna do a part 2 of this here in the future and show you when the assumption fails, look at a sub 2 transaction. It's a lot easier and cleaner. So listen, I hope this video was useful and helpful to you. If it was, do me a favor, like, comment, subscribe, maybe even share this with somebody you know that could benefit from this information or is confused around assumption loans and just needs to know this when they're out in the marketplace. You got any questions about your home buying journey, want to get pre-approved, or just want to talk about your current financial situation, maybe the state of market heading into 2025, do us a favor. Call us, email us, text us. We're always here for you. Until next time, stay tuned.